Okay, today I'm going to look at Parex Resources Inc., symbol PXT on the TSX, trades around 1750, $1.76 billion market cap, has a juicy just under 9% dividend yield. Parex is headquartered in Calgary, Canada. Operating office is in Bogota, Colombia. It's the largest independent oil and gas company in the country. That's Colombia. Parex is an oil-weighted producer focused on conventional high productivity reservoirs in Colombia. Now, let's look quickly here. There's a number of positives for higher risk energy investors, including the fact companies always maintain a relatively strong and unlevered balance sheet in a very volatile end industry. The company has also had a track record here, as we see, of returning capital to shareholders, continuing to pay and raise the dividend and buy back shares, reducing the share count and increasing cash flow on a per share basis. Let's take a quick at the company's long-term capital allocation framework here. Now, the plan is to reinvest about 2/3 of FFO or funds from operations into the business, and then return slightly greater than 1/3 to shareholders. This will drive. It's really driving their sustainable business model, investing in long-term growth and replenishing development inventory. They also have really just started the progress on their Big E. They call it their Big E investments. That's big swings designed to hit high impact reserves. This is essentially in Colombia and the potential to produce outsized returns for the business. The buybacks here that we've seen, they target dividend growth over time, ensure sustainability through the commodity cycle. So they're ensuring the payout ratio is relatively low, but they can grow that over time and is sustainable dividend through commodity cycles. Again, those share repurchases are continuing to reduce the share count and juicing the EPS or the FFO per share over time. Now, let's look at the 3-year growth plan. They're growing production and funds, what they call free funds flow from 2024 to 2026. The plan is based on an average of $70 Brent crude oil. 5% annual production growth is what they're targeting from their operating blocks. Spending around 375 to 450 million of capital per year. 50 million is invested of that in high impact exploration annually towards those Big E investments. Targeting 850 million in FFF, that is free funds flow, over the outlook period, so over those 3 years. Now, my comments on this would be the 5% production growth is solid given the natural declines of some of its older operations. As you can see, the LLA 34, which oil companies are really always fighting against. But I do think for the market to really get excited about the business, they would have to hit on a couple or one of their Big E targets. This is why we see the 50 million set aside annually for high impact exploration. Now let's look at the Q2 highlights here of the business. 2024 production shown here as oil and gas, or BOE per day, or barrels of oil equivalent per day, was down slightly year over year and sequentially. Better energy pricing helped improve netbacks or margins for the business. You can see there. We would prefer to see growing production. We do expect that to uptick in the second half of the year. FFO was up smartly sequentially, and lower CapEx increased free funds flow significantly sequentially. Let's look at product outlook for 2024 and their guidance. Parex's fiscal year 2024 average production guidance was 54,000 to 60,000 barrels of oil equivalent per day. Capital expenditures guidance of between 390 to 430 million, trending towards the lower end of their respective ranges. Lower production primarily reflects underperformance at one of its wells where it is drilling. Previously disclosed temporarily shut-ins in the northern Llanos, while lower capital reflects reduced spending on the Aruca and LLA 38, with some offset from the increased spending in LLA 32 and LLA 122 and Capachos. I'm sure I've blown the pronunciation on those, but you can read it on the screen, hopefully, and you understand what I'm saying. The balance sheet here, we'll take a quick look at it. It is very strong and should move to net cash throughout the year. 55 million in net debt, which is only 0.1 times net debt to EBITDA ratio, which is quite low, particularly for an oil and gas exploration and development company with production. Valuation summary: EV to revenue over the trailing 12 months is around 1. The EV to adjusted EBITDA fiscal year 2024 expected is 1.8, which is quite low. EV to cash flow per share is around, for this year, is just over 2. So the valuations and dividend the valuations, dividend, and return of capital appears to be attractive, yet the share price, as we can see here, is down 30% in 2024. Well, the declines, we would say, are primarily in relation to the forecasted production growth that has not moved forward as fast as originally expected. As a result, results have been lighter than expected, and growth is being discounted to a minimal rate. The near-term pessimism is likely overdone, but either a larger drill bit success from one of its big drills or programs, or a steadier sequential increase from a number of new wells is likely needed as a catalyst. Parex's Q3 production was below the consensus. The company's commentary that 2024 production results are trending towards the low end of guidance has hurt the stock. Q2 cash flow was ahead of consensus and but the beat on the Q2 cash flow was realized basically from an FX gain in the quarter. So we'd like to see it more from production gains. Parex is a potential option for investors looking for exposure to oil and gas, but we just released a buy on another new energy or oil and gas company with roughly 40% of its market cap in cash and likely a higher growth profile, at least in the mid-term. So that's my conclusion on Parex.
So Parex is, I like the structure of the company just because it has such strength in the balance sheet. Where in oil and gas, obviously, you're dealing with some times where you're going to be unprofitable, and yet you still likely would want to make capex. Because during those times, sometimes it can be the best time to make capex because the same things that other oil and gas companies are looking at, they can't afford. If you can, that can be great opportunities for expansion in the long term. Where if you don't have any cash, you're already in debt, you can't do that, and then you're further strained by the interest expense at the time. So it's always great to see a cash-rich oil and gas company, where Parex is right at the line right now. They're net, 0.1 net debt to EBITDA. Yeah. So effectively, they're neutral, and they've previously been net cash, which is something which I would expect them to be in the near term. They may already be during this quarter once this quarter ends. It would not be surprising. So that's something which I would really look at as when you're seeing really this negative momentum in the stock. If it does keep going down, let's say it stays the same, if they do start to build up a cash position, it kind of puts a lower bound onto where it can drop. So then you have that massive margin of safety. If you have a cash-rich company, it's been really beaten down by the market because they weren't able to hit their growth. If they're able to then return to growth, in Parex's case, let's say their Big E expansion, it plays out properly. It's executed well on. This is the bull case scenario, I should say. And then they're building the cash and the market's still punishing them during that time. That can be just absolutely lucrative in oil and gas, and it has lower downside risk because they're building up cash, which is just great.
Yeah. And I mean, you got that very strong dividend. I mean, dividends in energy producers, we consider almost a bonus, even though in this case, they've been very responsible with it over time. And they owe, many of the companies in the Western Canadian Sedimentary Basin that pay a dividend also have significant debt. So you're really, your cash flows can be squeezed in a down or negative market. Well, in this case, this company is typically operated with a net cash position. So if there was a quarter where they were really squeezed, or a period of time when they're really squeezed, they could still maintain that dividend. You don't want them maintaining it just out of cash, but it is there if you have the cash flow. or cash on the balance sheet too. It's not there if you're in debt, and that's the way. I mean, it is a capital intensive business. We get that many of them have to borrow to continue to grow the business over time, because you're always having to replenish those reserves. But if you can do it with a cash with balance sheet, at least it gives you that margin of safety. If you're going to pay a dividend, hopefully that balance sheet is strong, because that it is a volatile segment. And again, this company, if you look back 20 years, they have outperformed the set, like most Western Canadian just exploration and production companies. So a good name, and it is trailed back to what is a significant low, it looks like, on the company. So it's not a significant recommendation here today, but we can see the reason why somebody would be attracted to a company like Parex, particularly if they can go to growth again. If you can see growth again, then you've got some growth, you've got a good dividend, you've got a good balance sheet. So that's those things. And if you're trading at reasonable valuations, those are things that check off some of the boxes we're looking at. It's always going to be volatile with the price of oil. If oil has a great year, it does better. If it doesn't do as well. That's we're always going to say that.
Yeah. Now I will just add, on top of the dividend, which is already high, they are repurchasing significant amount of shares. It's not one of those companies which is that they repurchase 0.01% of their shares and they're calling repurchase. They're purchasing a percent a quarter right now.
Yeah,
which is just massive.
It is, for sure.